Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jon Ferro, along with Lisa Abramowicz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Joining us now is someone who really has inside knowledge and is a wonderful macro investor who has a ton of respect. Key Square Group founder and CEO Scott Bessent. Scott, thank you so much for being with us. I want to start with the idea of the Federal Reserve and its independence. What do you make of this actually being such a hot topic on the presidential campaign trail?
Well, I think it's kind of a canard that the financial press has blown up. All presidents want a say. And I think they have a right. Donald Trump is going to make his opinions known. I think Senator Warren, before the Fed decision, recently, the day before, said they should cut. The day after, she came out and said they made a big mistake not cutting. And I think that's within her right. And, I'm not sure, what all this is, or what this allegedly means that, people are saying Donald Trump thinks he should be in the room. If he wins, he will get to choose a new Fed chair. The Treasury Secretary meets on behalf of the administration with the Fed chair every week, so the administration's opinion is known. And I've written and talked quite a lot about. I already think politics are in the Fed because I think Janet Yellen's taken over the Fed.
Scott, though, when it comes to what Trump is saying, and JD Vance really doubled down on this yesterday on CNN, he said that fundamentally it should be a political decision, agree or disagree. Doesn't that thwart the independence of this institution? And haven't we seen that in the past under Nixon, and it didn't exactly work?
Well, I think it's all up to the Fed chair. And, the president, he or she, always has input. We saw from Joe Biden, State of the Union. I'm expecting a Fed cut. We saw a week later in Philadelphia, I'm expecting a Fed cut. Then the inflation numbers got hot. Oh, I'm expecting a Fed cut, but just a little later. So, presidents, make their wishes known. And, I do want to comment, I think this Wall Street Journal piece that referenced a 10-page document, I would challenge them to produce that 10-page document. I do not believe that document exists.
Okay, well, I just want to dig into something that you said. You think that Janet Yellen has already taken over the Fed. Mm-hmm. I wonder how much this is really in reference to the fact that the Treasury Department has been selling a disproportionate amount of T-bills. Some people say it's been offsetting some of the quantitative tightening as well as what we're seeing with respect to rate hikes over the past few years. How much do you believe that the Fed is way more political than people expect and that is something that you can trade around even?
Well, look, what I've been able to trade around, and, we'll go back. Your question on Yellen Treasury, highly political. Unfortunately, Secretary Yellen has thrust herself into the middle of the campaign in a very inappropriate way. She gave a highly politicized speech in Arizona a couple of months ago. She was standing on stage with the governor of Pennsylvania campaigning for Kamala Harris, who is not even, her president, 2 weeks ago. So it is politicized. The quarterly refunding schedule was changed. For the first time ever, they gave forward guidance. So how do you know what the conditions are going to be? Why do you have a Treasury borrowing committee if you are going to give forward guidance? So to come back to the Fed, look, the Fed, I think they try to keep politics out of it. We all have biases. 93% of the people at the Fed are registered Democrats. But I think in general that they are doing what they can with what they've got. Your question in terms of, how do I trade around that? I've actually had very good luck this year trading against the Fed. That anytime they publish their so-called dot plot, the SEP, the Summary of Economic Projections, they've been wrong. So for all year, they had 3 rate cuts. I didn't think there'd be 3 rate cuts. Then at the June meeting, they published that there would only be 1 rate cut. And we traded against that, and that's proving to be wrong because now the market's pricing in 3, maybe 3 jumbo rate cuts.
Scott, if we could look into some policy that has to do with the Fed and the Treasury. It's well known that you're one of these individuals that talks to the former president, potentially could be part of his future team if there's Trump 2.0. He gave an interview with Business Week and talked about a weaker dollar. How would he see that through?
Look, I think that's a preference, not a goal. That I think he believes, and again, I think about it more in terms of are other currencies undervalued? Is there some kind of a manipulation? I.e., the Bank of Japan running, ultra loose monetary policy for 12 years and doing a gigantic depreciation of the yen, where it goes to a 50-year undervaluation. Is there something that the Chinese are doing with their trade policy that is causing an artificially weak the RMB, versus a strong dollar? So, I think remedying, these undervaluations as opposed to remedying, a strong dollar is a better way to think about it.
Well, probably no one would like that more than Japan. I mean, they have not liked the weakness that they've seen in their currency. So do you foresee something like a Plaza Accord? Is that what we should be looking at? Should there be a Trump administration with these, again, specific currencies, renminbi, yen, to right-size some of the inequilibrium that you're talking about?
What was your question? Should there be a Mar-a-Lago Accord?
Mar-a-Lago Accord. Sure, we can call it that. Why not?
Well, I think that's what it would be called. That I could see, something, or a policy, specifically targeted at the different countries that are in violation, maybe rather than a global, thing like Plaza and Louvre was. If you go back and look, I've studied this a lot. What's different this time is if you go back and look at the history of the Plaza Accord, the Louvre Accord, the Soviet Union was never mentioned because their economy was so small. So you had, a security threat and then an economic threat. Now with China, I think we should view China as both a security threat and an economic threat, and it is going to require a lot more finesse with them just because they are such a big part of the global economy. So you don't want to upset the apple cart, but you want to be prudent in terms of supply chains and national security.
How do you then view a weak dollar, though, if Trump is saying that he's going to put up the walls for the tariffs, 10% ring around the United States, 60% of imports coming from China, as well as what he says, mass deportations?
Right. So I think we've discussed this before. President Trump speaks in a different way than many politicians. He speaks like a New York City real estate developer, and I think that is the opening, the gambit. I've used the term, it is a maximalist negotiating position. I think a lot of the analysis around this in terms of inflation has been quite sloppy. At our firm, we try to have better models. And, our models show that A, those are maximalist positions, and B, everything that I've seen, in sell-side research and other firms and commentators, assumes that there is a jump on day one, which will not happen. I have spoken to the president, spoken to his team, and I think everyone is on board with a kind of forward guidance or a phased-in tariff. So, here's President Xi, here's 60%. It might be 2.5% a month for 24 months. Tell us when you've had enough. And at the end of the day, I think that Donald Trump views tariffs as a way not to, as an end to free trade. If you bring down your tariffs, we will bring down ours. Recall that at the G7 meeting when he was president, he left Ottawa to go to North Korea, and on the way out the door, he said to all the leaders, I'll get rid of my tariffs if you get rid of yours. So I think he views like the tariffs as kind of negotiating, almost like a sanctions policy.
Well, Scott Bessent of Key Square Group, will you be living in Connecticut or will you be living in Washington, D.C. next year? We will find out. Scott Bessent, you'll have to come back, of Key Square Group. Resnick, co-founder of KSL Capital Partners, is focusing on the consumer and the outlook for travel and joins us now. And Eric, first, so great to have you on the show. Thank you for being here.
Thank you.
And your firm oversees tons of some of the most popular names that people go and visit, whether it is, the icon passes of ski lovers or whether it is the Marriotts and the Ritz-Carltons and the Four Seasons that people attend. Do you think that there is too much pessimism right now about this sort of pace of spending, particularly on the discretionary front?
I think there's too much reactionary thoughts happening based upon short-term data. When you look long-term, and I'm really here to thank you for being a customer of the Icon Pass. I'm on a swing. Yeah. I'm on a swing thanking each one of our customers personally, and this is my morning to thank you.
Okay, you can call him up if you've got an Icon Pass. And
that's right. I'm here. Yeah, feel free to call me. No problem at all.
Okay.
But the long-term trends for travel are really positive. People don't realize how actually resilient travel is, even in the face of economic volatility. We make what you were just saying. We have to embrace the mess. Life's messy, as you were saying, and the reality is, in that mess, what do you want to do? You want to escape. You want to be able to have special memories and experiences with your friends and family. And so we see the long-term trends being favorable. We do see the same type of softening of trends. It's still fine, still good, but it's not as robust growth in some of the segments that we invest in that we saw over the last 2 years coming out of COVID.
I guess that there's a bigger question. We were talking about this with Neela Richardson of ADP earlier this morning, and she was talking about how the pace of job creation is actually still above 2019. Mm-hmm. You can point to similar types of trends in travel. People still spending more on travel now than, say, 2019. Is this the new normal where we can expect more spending at an accelerated pace, or are we going back to the old normal where people actually had to work?
Well, the have to work thing is an interesting one. I do think that the trend of remote work, of people having leisure trips, we were just talking about this on the break, combining purposes of trips, I think that's all positive for travel. Because when you want to combine things, what do you tend to do? You're combining something that's vacation-oriented or recreation-oriented with what you're doing at work. So we see, skier visits, for example, are growing more rapidly midweek than they are on the weekends. Well, that's a better experience for the guests. It's better for everybody. I'm not sure about people saying they're working from home on Friday, if we know that skier visits are up disproportionately on Fridays. But be that as it may, we're pro that. So I think the new normal is, we're all on all the time. We want to combine purposes and be more efficient with what we do. So I think in the end, that's probably good. It probably creates more balance for people, and for us, it creates more opportunity for them to vacation and recreate and do those things that we certainly like to invest behind.
I just had the vision of someone like with their laptop on a ski lift, blurring out the background, saying, "Don't pay attention to the wind swinging back and forth," and what you're saying.
Right.
But so you're talking about the trend and the spend and how much that is normalizing. What about just what people expect when they go to a luxury hotel? Has something fundamentally changed after the COVID era of not being able to get out, and they now want something different with their hotel experience that they didn't before?
I think that's fair. I think they want to have more than just your basic hotel experience. During COVID, we saw an expectation that it's okay to reduce services at hotels, right? We couldn't staff, we didn't want to have physical contact, so we eliminated some of those things. That type of expectation has now come back, but the guest wants more than that. They want to be able to go on a trip. Business travel is different, but for leisure travel, they want to be able to go on a trip and have more meaning. So for some, that meaning is wellness oriented, and they want to do, it could be as simple as a spa treatment, it could be something that's more holistic in terms of mental health, or could be something physical, right? So I think the consumer, they just want more out of everything that they do. They want to feel that that's value.
What does that mean for the Airbnbs of the world? Where do they fit into that? Because they're not exactly providing that kind of service.
They're not. I mean, Airbnb and others in that business, they are trying to wrap around experiences. And you see experiences is a watchword that you hear on whether it's earnings calls or you see in consumer conversations. But I think Airbnb has that challenge, which is it's great if you're in a city because I don't need the restaurant necessarily or retail experience to be in my hotel in New York City. It's the city is my canvas, is my resort. But if you're in a resort destination, you want those amenities. That on the one hand, Airbnb offers wonderful value because you're getting more space and you can cook your own meals and congregate easily at your home. But it doesn't have the amenities, and I think they're trying to address that. And I think they'll have some success doing that, which is good for the consumer. And I think good for the business.
Where are travelers going right now?
I mean, you're seeing a bit of a dichotomy in that Europe is hot, Japan is hot, currency is part of that. Part of that is you took international away, right? What happens when you take something away from someone? I mean, if you're a parent of teenagers, you realize this. You take something away, they want it more. And COVID took international travel, especially, away from us. And with currency being, or the U.S. dollar being strong and foreign currencies being a bit weaker, combined with coming out of COVID, you're seeing a lot of the luxury consumer want to go to Europe, want to go to Japan, and so that's creating, kind of a normal or not yet a normalization of travel patterns. I expect that we're seeing it in some segments, but the consumers, the more budget-conscious consumer is cutting back a bit more right now. The luxury consumer is going more abroad. I witnessed, Lisa going abroad last week, but not to out you there, but
it's okay. Everyone's doing it this morning, so why not?
First day back from vacation. It's what we all do.
Okay.
So you're seeing a real bifurcation in where consumers are going?
A bit. If you look at select service spending for hotels, those trends are a bit softer than the higher end. In the last year, you saw RevPAR for more luxury travel to be positive still, 3-4%, while select service RevPAR is down. And I think that's indicative of that. But again, it's not dramatic. Right? These are evolutionary, not revolutionary shifts in consumer behavior that we're seeing. Normal volatility, not abnormal volatility.
One thing that you have is a really good lens on what the balance sheet equation really looks like right now, especially at a time where we are talking about increasing oil prices maybe on the margins. You see increasing commodity prices. You talk about how suddenly workers and that sort of consumer experience is much more important. How much are margins getting squeezed?
If you look over the last 4 years, or I guess now 5 years since pre-COVID, 2019, our margins are up. We've been able to move price more than our costs, even though costs are up a lot, right? I mean, the average worker wages in our sector are up probably 20% in the last 4 years, which is a lot, but price is up 20 to 25%. So that equation still works. I think if you have less distinctive properties or less distinctive experiences, you don't have that same pricing power, and margins are being hit more. And that's a challenge. I think right now, if you look at urban hotels, their margins are under a lot of pressure still. It's getting better as the business traveler has been coming back, but it's something to watch out for.
Are you seeing hotels trying to spend to be able to deliver that? And then what does that mean for margins? If in order to get the larger margins, you need to have this all-around experience, but to get the all-around experience, you have to build a lot of capabilities.
Like everything, it's a paradox in life. I mean, you have to be able to do two things at once, right? And so I think hotels that have the ability to spend on the consumer experience to create more differentiation and therefore, justify a higher price to that consumer because they're providing that value, they're doing that. I think you see that. But other hotels that don't have that ability, I think they're seeing more challenges. We're seeing that. We've got some wonderful resorts in Italy, in St. Bart's, that they put tremendous emphasis on the consumer and guest experience, investing in spa, programming, wellness, off-site activities, picking you up from the airport with a great car, those types of things at the luxury end, right? They're seeing prices that are exceptionally high and still able to push prices. At the other end, if you're a more nondescript hotel, I mean, it's tougher today because the consumer is being more discerning in how they spend their money.
So you talk about bleisure, which is a difficult word for me to get my head around. Bleisure. It's fun to say, actually, and how increasingly businesses are mixing business with leisure. What's your life like? I mean, do you basically just go around and just experience the different experiences that your properties have?
That's all I do.
And you just basically go there and you say, I need a spa treatment to really understand the value that you're providing.
Yeah, that massage wasn't quite as good as it should have been. I need to do another one.
Exactly.
Yeah, it's a lot of that.
Yeah.
It's not as interesting as as you would like to believe. Business trips do tend to be to probably some more leisure-oriented destinations than most, so it's fortunate in that regard. I spend a lot of time talking to the leaders of our businesses. We have about 25 business leaders across our portfolio. I spend a lot of time meeting with investors, meeting with other owners or constituents in the travel and leisure business. It's a large and growing sector, right? It's the third largest sector of the global economy. It's 10% of global GDP, 10% of global employment. But you have to stay connected to the ground of what actually is happening. Not quite the massage and the spa, although I try to partake in that once in a while. But I try to get a sense of what the consumer is looking for. And so I spend a lot of time on the road and a lot of time trying to understand consumer trends, investor trends, and the mindset of our management teams and the challenges that they deal with day to day.
And on the ski slope on a Friday to see how many people are working from the slopes. Eric Resnick of KSL Capital Partners, thank you so much for being with us. Truly a pleasure having you here.
No, thank you. Thank you all.
Sticking with retail, Daniela Bretthauer of HSBC maintaining her reducing rating on Home Depot, but lowering her price target to $318, citing the pressure of higher interest rates and lingering pandemic effects with do-it-yourself customers stuck on the sidelines. Daniela joins us now. Daniela, thank you so much for being with us. Just at an overview level, where are we in terms of the normalization post-pandemic where everyone went to sort of shore up their homes because they were going to be stuck there for the foreseeable future?
Hi, good morning, everyone. Thanks for having me on the show. Let me begin by sharing you our base case scenario for the U.S. economy, which stands the Fed should start easing in September and the U.S. economy avoids a recession. So that's HSBC base case scenario for the economy. And according to our regression models, currently, the market is pricing a 30% chance of a recession, up from 10% of a risk of a recession last week. So with this easing, the U.S. economy would avoid a recession. And we recently increased the number of rate cuts this year to 25 basis points, to a cumulative cut of 75 bips. And with regards to Home Depot, the current price is broadly in line with the stock's value in the last 6 months. It has been a favorite name for income investors that look for dividend yield. We have a 2.5% dividend yield for Home Depot. But, Home Depot has missed Wall Street's revenue estimates 3 times over the last 2 years, and weak consumer spending, higher interest rates, and the economic downturn recently could hinder sales recovery for the home improvement projects and negatively impact Home Depot's growth.
Daniela, we've been talking a lot about the bifurcated consumer, that you're seeing weakness on the low end. Is there any sign in any of these earnings that it is starting to migrate upwards?
So, thanks. Great question, because over the past few months, we saw more evidence of a tired consumer. Large cap names such as Walmart that operate in a more defensive sector of consumer staples tend to outperform under a risk-off scenario. And Walmart, which reports on Thursday, it's usually perceived as a good proxy to the state of the U.S. consumer.
Daniela, though, it's not just a good proxy for the U.S. consumer. On the lower end, according to Walmart's last earnings report, they talked about wealthier consumers trading in, trading down. So is this just says something about the consumer as a whole, or is it about Walmart taking market share from other players?
So the takeaways from the Walmart quarterly results are, 1, consumer wallets remain stretched, but they responded well to Walmart's strong value proposition. Second, food inflation continues to moderate. It's down from where it was at the end of last quarter, and it should stay at low single-digit rates for the rest of 2024. And third, the U.S. consumer, even the wealthiest one, is now shopping at Walmart. So they do have reported market share gains among higher income consumers.
Just quickly, Daniela, is there anything in the earnings or some of the commentary that you've been really focused on that suggests that we're headed into a bout of real consumer spending weakness beyond what people are expecting?
No, I think that it has, as you put it, it has been bifurcated since the beginning of this year. So consumers are spending more on travel and other discretionary purchases rather than complex housing projects or remodelings of their homes. So I think this scenario, until we get, again, a clear picture from the Fed, but even if we do get the cuts this year, it's something that only in 2025, given the new government and the results of the election, then I think that's where we'll get a more defined scenario for the U.S. consumer.
Daniela Bretthauer of HSBC, thank you so much for being with us.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.